Hello and welcome to another Innovation Explained video. The term disruptive innovation has made its way to the vocabulary of pretty much everyone in business. But like with so many other innovation-related topics, it's quite a complex and often misunderstood one, even by those actually working on innovation. So in today's video, we'll explain how disruptive innovation really works and then tell you what to do about it, both if you're about to be disrupted or if you're the disruptor. Let's get started. Now, disruptive innovation doesn't have a super snappy one-sentence definition, so it's perhaps easiest to first explain what it isn't. By far, the most common mistake there is to use disruptive innovation as a general term for every kind of innovation that is affecting a given market. Now, that's important to understand because if you try to apply the theory with that kind of a lens, odds are it just won't work. So what is it then? Well, it's probably easiest to explain with this image Professor Christensen first created to visualize the dynamics at play. I'll first set the stage briefly. The chart presents a given industry, and here the x-axis is time, and the y-axis is the performance of the product or technology for customers in that market. In basically every market, there's a certain minimum threshold you need to meet to be able to compete, even at the lower end of the market. However, it's the most demanding customers that are typically willing to pay the biggest premium for value, so that's where the majority of the profits are made, and thus is also where most companies want to be at. In practice, that can also depend a bit on how you define performance, but that's perhaps a story for another time. But to improve their profitability, a rational company wants to improve their performance and move up market to capture more of that profit. Once they do, they leave the lower part of the market open for a disruptor to come in and meet the needs of those customers better at the same or even a lower price point through a different underlying technology or business model or value proposition. Let's then look at an example to see how all of that works in practice. I'll use hard disks here, and more specifically the transition from magnetic disk-based hard drives to memory chip-based SSDs, because it's something we've all witnessed in recent years. Now, back in the day, most customers just wanted as much capacity as possible for the lowest price possible because storage space was still pretty limited. But as most people transitioned to laptops and memory chips became cheaper and cloud storage became commonplace, SSDs started to quickly gain popularity, especially in end-user devices. Once you get a large enough disk for a similar price, the other benefits of SSDs, namely that they are a lot faster, more durable, consume less energy, and are smaller than HDDs, were actually much more valuable for most customers than the absolute amount of storage available, especially since it also happened to coincide with the rise of cheap or even free cloud storage. So while the need for magnetic storage certainly hasn't gone away, essentially all of the growth in the market really came from SSDs, which of course wasn't great for most of the companies that had been in the magnetic disk drive business for decades. Semiconductor and memory chip makers like Samsung entered the market and gained a lot of market share, while most incumbents faced increasing challenges. Even a previous leader like Western Digital, that is still a major player today, had to purchase SSD pioneer SanDisk in 2016 for more than what the combined company is actually worth today to stay relevant. So, if we return to our chart, it's easy to see that in terms of the traditional performance metric of storage space per dollar, to this day, our disruptive innovation hasn't yet caught up with the performance of the sustaining magnetic drive business. There's still a sizable segment of longer-term storage needs of professional users and data centers where that's really important. But for basically everyone else, SSDs are a better option, and the trend is of course likely to continue. However, the important thing to understand here is that the shift started from the lower end of the market, as is always the case with disruptive technology, which in this case meant phones and other portable devices where the absolute amount of storage space wasn't as important as portability, reliance, and power consumption. Now, it's really important to understand that by finding that right segment at the lower end of the market, which isn't that satisfied with the status quo, and by then swapping out the y-axis of that chart, you can turn a structurally unattractive commoditized market into one where you can have a clear competitive advantage that customers are actually happy to pay for. So, even though the technology was much more expensive to begin with, which new technology often can be when measured with the same performance criteria, it was actually a much better deal when looking through the lens of these different value characteristics. And as the technology has matured, the disruptive technology has gradually caught up even in terms of the traditional performance metrics too. But the disruption won't be happening overnight, and it won't happen for the entire market at once. It's a gradual process that always takes time. So, with that example in mind, let's do a bit of a recap and look at what the common characteristics of disruptive innovation are in a nutshell. First, disruptive innovation always starts from the low end of the existing market. In practice, that means it's either a small subsegment of the existing market that isn't very happy with the status quo, or from total non-consumption. Second, and perhaps the least well understood of these, is that the primary value drivers for disruptive innovation are always different from the incumbents. This is a big part of what makes disruption so challenging. It's not just that there's a new technology out there or that somebody is cheaper than you, it's that the disruption fundamentally changes the dynamics and business logic of the current market. Now, this is vital for the disruptor because without this, they just couldn't compete with the incumbents, but it's also what makes it so difficult for the incumbents to respond to. They've spent years or decades perfecting their processes and business models, so it's quite understandable that they can't and usually don't want to change these anytime soon. Third, because disruptions start from those small and usually unprofitable niches of the market, the initial market size is of course small and the profitability pretty weak. And that of course means that these markets are insignificant for the incumbent and are often a drag for their overall profitability. So they're more than happy to divest or otherwise leave these for the new entrants and continue to move up market where most of the profit is. This dynamic means that for a long time, most incumbents don't see this as a threat to their business, but as a strategic choice they are happy to make voluntarily to focus on the most attractive parts of the market. And even if they do realize the threat, disruptive innovation follows an S-curve dynamic in its growth. Now that means that the growth is initially slow in terms of absolute revenue until the technology or business model is finally mature enough to cater to the mainstream. I mean, just take a look at this chart again. For a long time, it looks like absolutely nothing is happening with the disruptive innovation, while at the same time the sustaining one is going ahead full steam. So early on, disruptive innovation usually looks like a losing strategy on the surface. And it's nearly impossible to know how much of the market a disruptive technology will take over and when. Plus, because it redraws the lines of that market, you can't even have accurate data on the overall size of the market. So when you put together the small initial market size with a structurally low profitability and slow initial growth, and combine that with the risks of having to invest in immature technology and potentially cannibalizing your existing business, the business case doesn't exactly look very pretty. In fact, it's usually pretty much impossible to do an attractive evidence-based business case for investing in disruptive innovation. So it's not surprising that most incumbents choose to cancel these projects or not invest in disruptive innovation in the first place. At least until it's clear that the disruption will succeed in taking over a huge part of the market. And of course, at that point, it's often too late, or at the very least, much more expensive to invest in. And also, it's going to be much more difficult to move fast under that immense time pressure. Now, that of course begs the question, what should an incumbent do? Should we just throw away rational business cases and throw money at every possible new technology or business model preemptively? Well, not exactly. What disruptions do usually lead to many, if not most, players in the market to go bankrupt or at least face significant challenges. There are also plenty of large organizations that have successfully embraced disruption and reinvented themselves. We'll next give you an overview of the 4 primary strategies you can choose if your market is being disrupted. In a nutshell, the 4 are build, buy, partner, and pivot. In our experience, most of the debate usually revolves around the question of whether to build or buy, but partner and pivot are also commonly used strategies. We'll next cover each of these briefly. Now, build is usually the best option if you can pull it off, but it won't be easy. Historically, few incumbents have pulled this off, but there are of course exceptions like Netflix and lately companies like Microsoft in transitioning to the cloud. But it requires a strategic, long-term perspective and committed leadership, understanding of technology and business model trends, and the willingness to cannibalize your own business, as well as, of course, top talent to execute all of the above. Disruptive businesses are often fundamentally different from how the existing business operates, so that's why it's generally recommended to keep disruptive innovation independent from the rest of the organization. Try to be early in identifying potentially disruptive areas, invest in them to understand the dynamics at play there, but keep the investments modest and allocate more money only when real progress is being made, but make sure to look beyond business numbers here. Once there's real traction and the disruption is entering mainstream, you need to be prepared to move aggressively. Many incumbents, especially those that are financially strong and operationally complex, choose not to worry too much about new technologies or potentially disruptive innovations and instead opt for a strategy of simply buying out the competition if it looks like they're becoming a real threat. Well, if you have a strong balance sheet and execute well, this can again be a very effective strategy as it allows you to focus on what you do best, let those 9 out of 10 startups fail, and then swoop in to capture the one that succeeds before it's too big or expensive. However, with disruptive innovation, there are a couple of big gotchas here. The first is that once it's clear that a disruptor is going to be successful, that will usually show up in the valuation of the company too. While it hasn't always been the case, today there are plenty of investors with deep pockets around the world that understand how disruptive innovation works and that are willing to take the risk of investing in these companies at high valuations early on in hopes of hitting that rare home run. So, instead of being able to swoop that startup on the cheap early, it's much more likely that you'll be forced into a corner and have to pay a premium for that acquisition at a later point. However, even if you do identify the right disruptor early on and don't have to break the bank in doing so, you still need to manage the acquisition and the following integration the right way. The problem is that the traditional M&A playbook that your company is used to running and that typically focuses on deep integration, synergies, and economies of scale just won't work here. The reasons are the same as we've already discussed in the build part. If you fully integrate a smaller and slightly inferior competitor that way, you'll simply make their businesses better. But if you try to do that for the disruptor, odds are their business will be watered down to not cannibalize the existing business, and because they'll be forced to operate with the same model, that will cripple their business and you'll just end up with a very expensive failure. Just look at the 2 most successful disruptive acquisitions ever, YouTube and Instagram. Both were left to operate more or less completely independently, and the parent company simply actively looked for ways in which that disruptor could benefit from their existing assets and capabilities to make the new business better, not the other way around. And the studies back this up. The one thing you need to get right with M&A is to always add value to the target company's business. On paper, partnering often looks like a very attractive approach to quickly adding missing technical capabilities or addressing the needs of an evolving market. You immediately get access to capabilities you need and have to allocate no or very little capital to it, certainly dramatically less than with either a buy or a build approach, and it doesn't affect your core much. So, it isn't surprising that in a recent KPMG survey, it was actually the most commonly used strategy for addressing disruptive threats. However, in reality, the large-scale success stories from doing that are few and far between. The reason is that if you partner with a disruptor, you're usually making them stronger while simultaneously weakening your own position in the value chain, which in the long run is likely to hurt you more than it helps. And if you partner with a major company that isn't the disruptor but could in theory add similar technical capabilities for you, it's typically very challenging to get all of the pieces related to your technology, business and operating models right in a market that's being disrupted before you run out of time. And that is especially the case if it's a joint venture, which adds another layer of complexity. The Microsoft and Nokia smartphone alliance is a classic example of this. Again, in paper, it absolutely made sense, but in practice, putting two companies with losing value propositions together and then expecting them to suddenly turn things around just doesn't usually work that well. If you partner early and smartly and can identify disruptors that are on track to succeed and then acquire them like we just covered, this can still be a feasible strategy. And if you're really late to the party and missed your options to either build or buy, this strategy can keep you in the game and buy you more time to come up with an alternative approach. But that actually takes us to our last option, pivot. For a large organization, making a pivot isn't the same as it is for a startup with a few employees and a handful of customers. It's a major transformation that is inherently very painful and risky, so understandably, most are very reluctant to undergo one. However, if you're in a market where disruption is in full force and the other three are no longer feasible options, or you fail to execute them, it's your only choice to avoid bankruptcy or irrelevancy. In practice, there are two basic paths for doing this. The first is to simply accept that you'll need to divest or gradually ramp down big parts of the business and focus on just a few small niches within the larger market where you still have a sustainable competitive advantage. This is of course mentally difficult to accept for most leaders, since it would lead to the company becoming a much smaller and less important one overall. But there's also another more practical problem. What may seem like a sustainable competitive advantage now might not be one going forward if the disruptive innovation still continues on the same trajectory. And the second is to make a series of moves to focus on a completely different business where you might actually be able to compete, which typically means moving to an adjacent market. For example, that's exactly what Nokia did once they realized they couldn't compete in smartphones. They sold the entire phone business, which had long defined the company, to Microsoft. And despite the troubling market position, they still managed to get a decent price for the business and then used that money to buy Siemens out of their joint venture in networks. While obviously painful and criticized by many at the time, it turned out all right for Nokia and was probably the only way to keep the company alive. So, to conclude, if you're an incumbent, the build or buy strategies are your best bets to succeed in a market that is being disrupted, but neither is easy to pull off in practice, and both require strong leadership and competent execution. Partnering can be a way to dip your toe in the water or to delay the inevitable, but even though it's super popular, in the long term it's almost always a losing strategy. And finally, while pivoting can work even before your back is against the wall, it's such a bold and painful route for a large organization to undertake that it's generally only the last resort, and quite justifiably so. So, while being disrupted is a very challenging situation for an incumbent to be in, being the disruptor isn't exactly a walk in the park either. Let's look at what you should do if you're a disruptor or are working in an incumbent focused on building one. Here, the process is actually pretty straightforward. You'll first need to identify value drivers and customer segments that will allow you to dominate certain segments of the market or create demand for non-consumption. But that will ideally also allow you to keep moving up market and steal an increasingly large market share once you do. Then you should validate the value proposition for that customer segment. And this part of the process actually serves two equally important purposes. The first is to validate that the value proposition actually resonates with the customer segment, and the second is to validate that you can actually deliver the proposed value for the customer. You shouldn't bother perfecting your offering at this point. You can achieve both of these goals just fine with a good prototype or a simple minimum viable product. Once you've validated both, the next step is to build a mature enough technology, business model, and operating models to cater to these markets profitably, at least on the unit economics level, and to do so in a way that can be scalable. In practice, it's pretty common to have operating losses early on, and that's fine if those come from calculated investments into building the business. But if the unit metrics don't work and you end up with a negative or extremely low gross margin, you're basically just throwing money away. If the model doesn't work, it's time to get back to the drawing board and try to either improve the product or technology, or then pick a different segment where your value drivers would resonate better and be worth more. Then, the fourth step is to scale up by simultaneously creating more value and driving costs down. In practice, this happens with a combination of incremental innovation and economies of scale, as well as, of course, solid commercial execution. Now, all of that is, of course, easier said than done. The last three are pretty extensive topics on their own, so we won't cover those in depth today, but to get you started, we'll help you with the first one. For figuring out what ideal customer segments and value drivers would be in your case, my favorite framework is the Blue Ocean strategy. We'll add links to more materials if you're interested in learning more about it, but essentially the idea is that you want to find a strategy and a segment of the market where you have such a strong position that the competition is basically irrelevant. Ideally, you'd be both better and cheaper than the alternatives. However, to achieve that, you have to identify value drivers where you are clearly better or can realistically become clearly better, together with parts of the market that actually value those same drivers. Realistically, that won't be the whole market, at least in the beginning. By now, that sounds pretty familiar, right? So, in theory, you can approach the framework from either direction. By just choosing a segment and then figuring out the disruptive technology or business model that will work here, or by already having a technology or business model you think can disrupt the market and then just identifying the right segment to start with. Both approaches have their merits, but it's good to remember that in practice, truly disruptive technologies are often more difficult and time-consuming to master. However, let's see what this looks like in practice by looking at another example. I'll use Viima's idea and innovation management software here since I obviously know it well, but I also think it's an interesting example because when we first founded Viima and entered the innovation management software market, there were both many strong incumbents and plenty of non-consumption. If we look at the incumbents with the help of this Blue Ocean strategy canvas, basically all of them operate with more or less the same model. They sell large enterprise software packages that are separately configured and usually installed on-premise. That is packaged together with professional services to help them make the most out of that software. It's a proven and profitable strategy, and if the software and services are good, their customers are usually pretty happy with that approach. However, there are also drawbacks. For some, these are too complicated and difficult to use. They'd prefer something that's simply easier and just gets the job done well. And while those enterprise-focused suites are flexible through customization, they don't usually allow you to adapt the changing requirements yourself on the fly, which many innovators operating in rapidly shifting environments really value. Nor do they allow you to use the same software to run completely different kinds of innovation processes and campaigns at the same time effortlessly. And of course, for most organizations, they're just too expensive. And even those that can afford it but know what they are doing often prefer a more self-service approach, as that saves them both time and money. So we set out to build Viima to excel in these needs that the incumbents either don't want to do or have a hard time adapting to, and at a clearly lower price point than the incumbents. To do that, we took a very different product-led cloud-native freemium approach and ruthlessly eliminated or automated things that weren't essential for most. And interestingly enough, that's allowed us to achieve the highest margins in the business even with the lowest prices. We aren't the best solution for everyone in the market, obviously, and don't even want to be, but we're certainly striving to be the best option for most companies. Alongside us, there have been other entrants with a pretty similar strategy, and that's put a lot of pricing pressure on many of the incumbents, and as usual, they're looking to maintain margins and keep moving up market. So while the shift towards self-service is quite disruptive for the incumbents, we think most of the future growth in our market will actually come from non-consumption, which makes this an example of a market where disruptive innovation doesn't just steal market share, but can actually make the market dramatically bigger. To conclude, Once you understand how disruptive innovation really works and accept the uncertainty and the many mental traps associated with it, there are actually plenty of strategies that allow you to use it and tip the scales in your favor. But that's it for today. If you have any questions, please leave those in the comments below. Thanks for watching. We'll see you again in the next one.